Good afternoon, everyone. My name is Marissa, and I will be your administrator today. Welcome to the April 2023 First Friday webinar. Today's presentation is titled Crossfire. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be between 15 and 20 minutes long, with some time left over to cover questions from the participants, along with our standard topics, which are: what is the market missing? And what is the fair value of the market based on our current assumptions? If you have already sent us your questions, we want to thank you, because your questions help us understand what topics are truly important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question in the chat box at the bottom of your screen, or write it down and raise your hand at the end by clicking on the icon at the bottom of the screen, and we will do our best to come to you at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Great. Hey, everybody. Let me take a moment and as always, just to welcome everybody to April's First Friday discussion, and thank you for tuning in. We have a really interesting topic at the end here. I'm hoping that each of you can hang around and for us to discuss about what the market's missing. It's the market usually isn't as ignorant about an event that is likely to take place coming up as it is today, and the fat tail events of this, meaning the consequences of missing this event, could be significant. So with that said, let's kind of move forward and start. I want to say in the beginning that I don't recall a period where there's been such a significant disconnect between the data that are relevant to the marketplace and the market's reaction to the data. Said differently, the signals or the leading economic indicators, as we went over last month, are telling us difficult times are likely over the next year, actually are almost baked into the cake. While the stock market is priced in a near ideal future. I want to assure each of you that we, as intelligent investors, should be paying attention to the leading indicators, and you shouldn't be paying attention to the static or to the noise. The leading indicators or the signals are important. They're just a few of them. They're easy to keep up with, and I keep up with them quite often. And the noise I want you to try to tune out, because it's just going to be, it just gives you the wrong indications about what's to come. So today we want to go over a couple of different, I guess I would say a couple of different topics. And at the end, we want to go over, as I said earlier, what the market is missing. So today our talk is labeled as Crossfire, and what we're talking about is Crossfire when I guess when at war, both sides of the warring effect are focused on winning, and when large numbers of people are involved, the elements of Crossfire can often and really do produce unintended consequences. Sometimes people are killed by their own sides, and those are incredibly unintended. And I think the Fed has a really difficult time ahead of it. It isn't that they didn't create it themselves, because they did. It's their fault. But that's history. What's ahead of us is really going to be very difficult. And as this slide reminds us, that Crossfire takes place all the time, and the unintended consequences of inflation currently is raging in our country. And as we went over the last the 2 months each, while the market believes that inflation is going to be cured by the end of this year, history says that inflation, once it exceeds 8%, takes between 6 and 13 years to come back down below 3%. It doesn't mean that this time won't be different. It just means that history says that the market is really, really wrong. So for the discussion today, we're gonna talk about three main topics, and we're gonna leave some time for questions for those participating today. So, will the economy enter a recession in 2023? Was the most often question I had this month, and we'll first go over the dangers associated with the recession and why that's important, because some people aren't in clear, very clear about why that's really, really important. And then, as every self-respecting analyst will challenge, what are the consequences if we invest as if we're going into a recession and we don't go into a recession? What's the downside available given current market valuations? We also want to go over a little bit about investing defensively. And finally, as I said earlier, we're going to go over what the market is missing. And as I said earlier, the upcoming event is being completely overlooked or misunderstood by the U.S. and the global capital markets. And I mean the global capital markets too. So I'm hoping we'll look back on this event or this topic and say we were at least aware of what was going on, because it could issue a real shock to the global marketplace if we don't handle this correctly. Okay, are we going into a recession? So most of you will remember the discussion last week between the value of signals, which are valuable pieces of information, as opposed to noise, which, as we defined last week, offers static and often deceptive information. And it's really often counterproductive. It's static or noise is the type of information that you hear from the talking heads on TV, that they don't really understand what's really leading and what's lagging. Inflation is a lagging indicator. Employment is a lagging indicator. They don't tell you much of anything about what's to come. The three indicators that we're going to discuss again just one more time today, just to make sure that you're following these, are leading indicators, and they're incredibly prescient. So the three important indicators are is the U.S. Federal Reserve increasing interest rates, or are they decreasing interest rates? In short, the Fed's trying to, if the Fed is decreasing interest rates, they're trying to increase our economy. And if they're, increasing interest rates, they're clearly telling you they want our economy to slow. And it's pretty difficult to bet against the Fed. There's all kinds of sayings out there. One that most of you have heard: "Don't fight the Fed." It usually is said when the Fed is easing interest rates. But believe me, it works in the opposite way too. When the Fed is increasing interest rates, please be aware. So this slide clearly demonstrates the relationship between the U.S. Federal Reserve and the stock market. As you can see, in the early 1980s, the Federal Reserve started decreasing interest rates, and as you can, in the blue line, and as you can see in the green line, over that time period, from the early 1980s through to 2022, the stock market has appreciated 40 times. So that's really taking interest rates from the teens, from the 15 to 18% range, down to the 0% bound. And as you can see, oppositely, as interest rates have started to increase in 2022, the market has started to depreciate. The second signal is related again to the US Federal Reserve, and it's the inverted yield curve. And this is almost flawless. When short-term interest rates are low and long-term interest rates are higher, the world's economic compass is normal. It's in good shape. And the reason for that is because banks borrow money they borrow money from your savings rates, your savings accounts. And as we learned from Silicon Valley Bank and Signature Bank and several of the other recently bankrupt banks, they borrow from you at short-term rates and they invest at long-term rates, which creates a terrible mismatch when there's a run on the bank. But we won't go into that right now. The bottom line is, because banks borrow money at short-term rates at the lower end, and they lend money for the long term, they capture the spread between that too. And when the yield curve is inverted, meaning short-term rates are higher than long-term rates, it disrupts everything. Banks stop or curtail lending. Loans aren't available, or if they are available, they're available at incredibly high rates. So the bottom line is, it discourages borrowing, or from the bank's standpoint, it discourages lending. And an inverted yield curve, as you can see, has an almost 100% correlation with oncoming recessions. So it's almost flawless. The last of our signals is the index of leading indicators, and that its namesake should be enough for anybody to follow, and it's widely available to you. But please just make a note of this and follow it every now and then, or give me a call. I follow it all the time. As you can see, it's been trending down in the bottom right-hand corner. It's been trending down for 12 months. We went over this slide last month. The leading economic index is right over 90% of the time, and it acts with about an 8 to 12 month lag. It's incredible, it's incredibly indicative of what is to come, not in what has been, no, not as what has been. So let me just say this as a summary, and to reiterate what we said last month. Each signal by itself, whether it's the Fed increasing or decreasing interest rates, whether it's the inverted yield curve, or whether it's the index of leading economic indicators, each one is powerful by itself. And when they turn negative, you need to be aware of that. But when all three of them are telling you that you should be expecting a recession, it's a very powerful indicator. It's not necessarily baked in the cake, but it's as close as you can get. So the bottom line is, the odds are very high that our economy is going to enter a recession in the next 12 months. And that brings us to our second question. What are the dangers of investing during a recession, and what are the penalties for being wrong? So the danger is made of two, how would I say this, of two related events. The first event is that in recessions, activity or economic activity declines. This means earnings decline. Earnings define the value of any financial asset. And as we discussed last month, a company earning $1 per share is worth X dollars. And a company earning $2 per share is worth double that. And a company earning $4 per share is worth 4 times the original company. So what I'm trying to say to you is, as earnings decline, asset values decline. So in summary, the primary risks of a recession translate into lower earnings, and lower earnings translate into lower asset values. Here's the beginning of the end. So this slide demonstrates that profit margins, which are that's the fountain of youth of earnings, they've already started to decline. And we went over again for some of you that were with us last month, you would have seen this chart. It continues. These profit margins are continuing to decline. Yes, they're declining from a very high level, and you would have expected that, but they're declining at such a rate that is a little bit unusual. Corporate margins, in short, have turned down, and earnings are sure to follow. What's the downside? Well, let's first figure out what expectations are, because downside emanates from expectations. So here is a chart, again, we've seen before, but it demonstrates what is expected, or the analytical community on Wall Street, this is what they expect. They expect $230 in earnings for 2023 and 250 plus in earnings in 2024. That's up from $220 in 2022. My point to you is that while this is possible, it is highly, highly unlikely if we enter a recession. It is incredibly unlikely if we enter a recession. So that's the beginning of the downside. What does it mean? Here's our updated slide that we again we sort of base our conversation on, and it's easy to do the math. We believe that earnings per share are lucky to be at $200 a share this year. I mean, really lucky to be. That would mean earnings were only down 10%. And by the way, I just want to make sure that I tell you that the average downturn in earnings during a recession is 20%. So that says, if you use the averages, the $220 in earnings should be more like $180 in earnings. We're giving it a slight benefit there and trying not to be so draconian. But at $200 a share, with the average multiple of earnings of 15 times earnings, that's a $3,000 S&P 500. Currently, the S&P 500 is at 4,100. That's 1,100 points downturn, or over 25%, period. That's the minimum. And I want you to understand that if you'll go back and look at any point in history, there's never been a downturn that stopped at the average multiple of earnings. They almost always exceed earnings. And that's as the narrative changes from people trying to buy every dip because the world is getting better. And over time it will. I'm with you. But the bottom line is the narrative will change until you hear people saying, get out at any cost. And I don't want to hear about another stock. That's when you'll know that the bottom is probably in. Okay. Here's an indicator that isn't as well documented, but I wanted to bring it up to you because it supports the chicanery that Wall Street goes through. It shows clearly that when GAAP earnings are lower than operating earnings, it shows that Wall Street is spinning a web of BS to the world. GAAP earnings are generally accepted earnings from the accounting community. Operating earnings are what Wall Street often tries to sell you, but GAAP earnings are what matters. And when GAAP earnings are lower and turning lower, and operating earnings haven't really how would I say, changed or caught up, it's usually the beginning of the end. It really represents trouble. Okay, so what happens if we're wrong? What happens if we're wrong? And this is analysis 101. Every analysis ends with the same question. What happens if your analysis is wrong? What is the price you're going to pay? Here's a chart that shows the geometric mean of the S&P 500. And let's not worry about the math that goes into this. It's the most reliable estimation of valuation. The bottom line of this is we're 2 standard deviations above the mean. We're over 90% overvalued. And my point here is that when you're over 90% overvalued, to get back to fair valuation, you have to be down over 40%. So my point here is that investors who are banking on or counting on appreciation for their securities, as opposed to investors who are counting on income and dividends and in other what I think are intelligent methods of pulling return from the marketplace, they're going to be disappointed. Period. The market will get back down to fair valuation. And as you can see from almost every one of the recession periods, which are in dark, the downturn seldomly, if ever, stops at the mean. So, investors with a largely defensive posture, or even out of the markets currently, I think will have very little at risk. So I guess my point is, if you're wrong, you almost have no downside for being defensive right now, and for not trying to be a hero and participate in an overvalued asset class. Here's a slide we showed you last month, and I hate to bring it back because it's complicated, and I want to try to explain it to you one more time because it is the most highly correlational chart that I've almost ever seen, and it's really sensible. That's sort of an engineer's credo. So if you go back over 100 years, which demonstrates that this chart demonstrates clearly that when you overpay for assets, your future return is diminished. And it makes sense. Just think about it for a second. If you pay, if the house that sold down the block for $500,000 last year, if you pay $1 million for it, it's quite likely that you're going to have a lower return than if someone who paid $505,000 for it, in the next month. If you take a moment and look at the relationship between the valuation, which is the orange line, and the returns that you received with a 10-month lag, a 10-year lag, which is the green bars, you'll clearly see that as valuations increase, returns decrease, and it's almost 100% correlation. I'll leave you with this thought. If you'll take a look at the right, where the orange line is currently, you'll see that we are at not record levels, but near record levels. We're at ridiculously high levels. And that just says that for the next 10 years, those people that are investing for appreciation, they're likely to be severely disappointed. The bottom line, and I'm not trying to be arrogant, but it's highly unlikely that our analysis so far is wrong. However, if we are wrong, um, intelligent investors have little, if anything, to lose, as the market is so overvalued and future returns, um, future investors, depending upon returns based on price appreciation, as I said earlier, they're likely to be incredibly upset. Um, Wait until things get to be more reasonably valued. Okay, so what's the market missing? And this is an easy one, but it's sort of a second or third order effect, which most people won't have been focused on yet. So we have the budget impasse, and it happens every other year or so. Sometimes it happens every year, where the political sides are are holding each other hostage because we always run a deficit. And it's really it's discouraging, but it happens all the time. This is not about them settling this, because they will settle it. The odds of the United States defaulting, they're not zero, but they're in the 1 to 2% range, and I wouldn't count on that. I think that they'll find some kind of common ground and they'll settle this. That's the first order effect. But here's what I want to show you. The second order effect is the budget deficit is going to be between 500 billion and 1.5 trillion this year. I don't know the magnitude of it, but I do know that those are reasonable bounds. It could be a little higher. It could be a little lower, but I doubt it. The reason I bring this up is that when that budget deficit is settled, we need to create that money, which means we need to go out and sell bonds. For the United States to go out and sell 500 billion to 1.5 trillion dollars in bonds in a hurry, that's hard. And what that means is when a seller comes into the market, it will push bond prices down and yields up. As yields go up with the amount of deficit that we have now, don't forget we're now at over 30 trillion in outstanding bonds that interest is due on. Our projected interest rates only, not paying back principal, just interest rates only, exceeds 750 billion per year now. So we start out with our budget with a 750 billion dollar debit before we even get started on defense spending and social categories. We're in trouble, guys. And my point here is if the market doesn't buy our bonds, which it probably will, they're going to ask for a much higher a higher interest rate. I don't know what much higher means. The point of all of this is that we've got trouble coming. We've probably got a 2-month reprieve here in which we don't hear much about this because the sessions of Congress probably won't bring it up. But I'm telling you that for the US to go out and raise $1 billion plus in a very short amount of time is going to cause ripples in the global marketplace. That's what I think the market is missing. And we'll see whether we're right or not. Let me stop there because I think I've overstayed my welcome a little bit and ask Marissa. I think I see that there have been a couple of questions that have come through. So can you give us those questions and just give us those questions one by one, and let's see if we can do our best to provide answers if we can.
Yeah,
And
for
by the
sure.
way, if anybody has questions, please feel free to type them in the chat box at the bottom, or to raise your hand, and we'll put you on here.
Okay, so for our first question, it says the leading economic indicators are not a secret, and most institutions have access to them. So if they are all indicating recession, why is the market still within 15% of its all-time high?
Yeah. Yeah, the wisdom of the markets was a book written by James Surowiecki. He's a friend of mine, and the reason I bring that up is that the markets are almost always right. So it's a really good question. So I would say that this question came up in different words last week and or last month. I would say that while it's foolish to attempt to explain why any global market acts in any specific way over the short term, the market clearly believes the U.S. Federal Reserve is is going to be able to engineer a soft landing or no recession, despite what the despite what the indicators are telling us. The market is saying the Fed is going to win, and it's it's remarkable. The market almost always does this, and the Fed almost never wins. There's a 90% rate of the Fed screwing this up. So the bottom line is the history doesn't support this. The data don't support this. Um, the signals don't support this, and the leading indicators don't support this. The market clearly believes, corporate earnings are going to increase in 2023 and in 2024. Wall Street has an incentive to sell you this. They always do. That's why we should almost never trust Wall Street. Um, and The bottom line is the Fed is tightening. They're telling you they want the economy down slower. The inverted yield curve is penalizing banks for lending long, not to mention the fact that we've already seen the banking sector start to crack. It's the same thing that happened in the great financial crisis back in 2007. There was about a year between Bear Stearns folding and Lehman Brothers folding. And before Bear Stearns folded, there were a bunch of, you remember Washington Mutual and you remember Wachovia. All of those banks went away. And it really ushered in a very vicious moment in our history that most people don't really understand how vicious it was. I'll stop there, but the bottom line is it's a good question. I don't know why the market isn't paying attention more to it. And all I can tell you is to please not follow the static, not follow the noise, follow the leading indicators, and they're all telling you that this is not a time to be heroic. Marissa, is
Okay,
there another?
thank
I
you.
think there's another one.
Yeah. So Steve, you mentioned there was a second order effect which often takes place as a result of a recession.
Yeah.
Yet you didn't tell us what that was. Can you go over that second order effect?
Yes. I goofed it up. Sorry, I missed it in the presentation. What I said was that recessions have two levels of events. The first level of event is that earnings decrease, therefore valuations decrease. What I didn't go over was the second order effect, or the second level effect. When earnings decline, some companies who have been tiptoeing around or between solvency and insolvency. So these are the companies that are barely profitable, or the companies that are unprofitable. And by the way, just to make sure that we're all on the same page, over 20% of the Russell 2000, that's 400 companies, are insolvent, or I'm sorry, they're we call them the Walking Dead, meaning they haven't earned enough money to pay back the interest rates. Forget about the principal, but just they don't earn enough money to pay the interest rates on their debt. And when that debt comes due, they are all done. So my point is, when those companies which were tiptoeing between solvency and insolvency, when they finally go under, the unintended or secondary or tertiary consequences of this is that all of those companies that depended on that company, they will also become tenuous or insolvent, period. So what I'm describing is what's very hard to price into the market, and that's the domino effect of a really bad marketplace, a really, really bad marketplace. I can show you chart. If any of you have an interest, please email me or give me a call, which is better. And I can show you chart after chart of the amount of debt that is unable to pay its interest rates. We call it distressed debt. That's not to mention the fact that commercial real estate, between now and the end of 2024, there's $1.5 trillion of commercial real estate coming due to be rolled over. And the banking sector, which was the commercial banks and the regional banks, they make about 80% of those loans. They're both going to be under intense scrutiny by the banking regulators now that we've had Silicon Valley Bank and Signature Bank and several other banks become insolvent. And all I'm telling you is everything is tightening up, and it's tightening up faster than the Fed. I think faster than the Fed really wanted it to. So I wouldn't be surprised to see the Fed pause. I think they won't pause, but I think that I wouldn't be surprised to see them pause. The market will be very comfortable with that, very happy with it, saying that the end is near, but I'm just not sure it is. And the bottom line is the second order effect, sorry to be so long-winded, but the second order effect of this is that there's a cascading domino effect of bad earnings, insolvencies, and that typically really, the saying is that it happens very slowly and then it happens all at once. So it's going to be very hard for people to realign their assets once this happens, if it does. And I hope that it doesn't. I hope that I'm dead wrong about this. But the second order effect during a recession is vicious and quick. Marissa, anything else?
No, that was it. Thank you, Steve.
Okay. All right, guys, if there's any questions that you want to discuss personally, please feel free to give me a call. I'll be here for another 40 minutes or so. And if not, I'm usually around on Saturdays on and off, and next week is all game. So in the meanwhile, I'm hoping all is well with everyone, and I look forward to seeing you on the next First Friday or talk to you sooner. Bye.